There are only 4 pathways to becoming super wealthy. Each pathway has its own unique operating mechanisms and risk-reward characteristics. And understanding these routes is crucial for anyone serious about building significant wealth. The first pathway, leveraging other people's capital to build your empire. When you look at some of the world's most successful business titans, you'll notice something fascinating. Elon Musk owns just 17% of Tesla, Jeff Bezos holds roughly 10% of Amazon, and Nvidia's Jensen Huang owns only 4% of his company. Despite these seemingly modest ownership stakes, all of these entrepreneurs became billionaires. They understood and mastered the first pathway to super wealth, injecting other people's money into their own ventures. The essence of this approach lies in raising capital by selling company equity. While this dilutes the founder's ownership percentage, the influx of capital can fuel massive business expansion. For certain types of businesses, this isn't just a smart strategy. It's the only realistic way to achieve their ambitious goals. Every business starts with some form of debt from day one. The key is choosing what type of debt to take on. If you choose to bootstrap and reject outside capital, you're taking on talent debt, inability to attract top talent, technical debt, lack of sufficient funds to build proper technology infrastructure, and various other forms of non-financial debt. Businesses that choose to take on financial debt typically do so because of the competitive dynamics of their market. These businesses either require massive startup capital or operate in winner-take-all markets where speed is the key factor in capturing market share. Facebook has largely monopolized the attention economy. While other social media platforms exist today, Facebook built massive moats around media attention. LinkedIn created a professional version for business professionals. Once these platforms established their leading positions, it became extremely difficult for late entrants to gain a foothold. The companies that can raise the most money, spend it fastest, and attract the best talent often capture market opportunities quickest, thereby cementing their competitive moats. This means these businesses will lose massive amounts of money in the short term, then cross the profitability threshold to become money-making machines. Amazon's case of being unprofitable for 9 consecutive years is a classic example. When making investment decisions, Bezos didn't ask, "What will change in the next 10 years?" but rather, "What won't change in the next 10 years?" He realized that people will always want faster, easier, risk-free results. This corresponds to the core elements of the value equation. Time delay corresponds to speed, ease of use corresponds to effort level, perceived likelihood of success corresponds to risk, and dream outcome ensures the product is truly what people want. Amazon's entire review system was created as a transparency mechanism to reduce purchase risk. One difficulty with accepting VC funding lies in the nature of the capital accepted. Every investment is a unique deal, depending on the company's risk profile, the investment firm's risk appetite, and investment philosophy. Different VC firms have vastly different investment strategies. Some focus on deep investment in single sectors, while others take a spray-and-pray approach. This difference affects what's demanded of businesses. Some VCs might require a company to achieve 10x growth within 2 years, forcing founders to adopt aggressive growth measures that sometimes aren't optimal for the founder or the business's long-term development. As funding rounds increase, investors typically gain board seats. Founders may find themselves owning only a minority stake in their business, losing voting rights, and potentially even being ousted from the companies they created. Steve Jobs being kicked out of Apple for several years is a classic example. Path 2. Bootstrapped entrepreneurship. Opposite to the first path is using your own money to invest in your own business. This is probably the most common path for entrepreneurs, and many admirable entrepreneurs adopt this model. The key concept is, urgency is often imaginary. 99% of businesses don't need aggressive growth timelines. Whether it's opening a chicken restaurant or a lawn care business, most businesses won't build network effects and simply need to consistently compete and do good work in their local or specialized service areas to achieve good returns. Understanding compound growth mechanisms is crucial for bootstrapped entrepreneurs. To achieve compound growth, you need to build some form of compounding mechanism. This can be achieved in 2 ways: selling products people never stop buying, like Coca-Cola or Starbucks, or building a distribution network that never stops selling for the business. For bootstrapped entrepreneurs, the growth path is through return on invested capital, ROIC. This concept extends from the most basic customer lifetime value to customer acquisition cost ratio, LTV/CAC, to larger-scale capital investment returns. For example, If a gym requires $50,000 to open and generates $250,000 profit in 12 months, the return on invested capital is 5 times. This means the entrepreneur can use the $250,000 profit to open 5 new locations, thereby earning $1.25 million the following year. This is the mechanism of compound growth. Path 3. Becoming a wise investor. When entrepreneurs start generating excess cash flow from their businesses, they can consider the third path, using their own money to invest in other people's businesses. This is the traditional investor's path, similar to the investor role on Shark Tank. Investors primarily provide risk sharing. They exchange capital for a percentage of the business's future earnings. The investor's advantage lies in being able to diversify broadly, spreading investments across multiple projects to reduce overall risk. Statistics show that real estate has created more millionaires than any other investment vehicle, but private equity has created more billionaires than any other tool. This is due to the different nature of risk and return concentration. For investors, any single investment might represent only 1% of their portfolio, but for entrepreneurs, this might represent their entire net worth. When selecting investment projects, several key criteria are worth attention. First is high cash flow and profitability. Investing in businesses that can generate stable cash flow allows for regular distributions to offset principal and provides faster feedback loops on business performance. Second is growth potential. Businesses essentially grow in only 2 ways: increasing the number of customers or increasing each customer's lifetime gross margin. If you can clearly see a path to help the business acquire more customers or significantly increase customer value, this will be an attractive investment opportunity. Third is focus. Excellent founders should be able to focus on specific customer groups, deeply understanding and solving their problems. Overly broad target markets often mean nothing gets done well. Among all investment considerations, the quality of the founding team is most critical. Borrowing Warren Buffett's 3 core values: competence, work ethic, and integrity. The founding team must possess the ability to solve countless problems in dynamic environments, because business environments are inherently changing. Many famous companies weren't even their original intention when founded. For example, Slack was initially a video game company that eventually pivoted to engineering communication tools. Excellent founders possess the ability to adapt and pivot, which is almost like insurance for investors. When analyzing investment opportunities, you can apply the theory of constraints. Systems will grow to the constraint point and then stop growing. Once you find the business's constraint, you should focus all resources on attacking that constraint to unlock the next level of growth. For instance, if you increase advertising spend for a lawn care business by 10 times, but don't correspondingly increase sales staff to handle leads, the constraint will shift from marketing to sales. Constraints will continuously move along the business process until the entire business removes constraints, achieving dramatic increases in throughput. Path 4. The ultimate leverage of fund management. The fourth path is using other people's money to invest in other people's businesses, making the investor a fund manager. This is the most leveraged way to achieve extreme wealth. Take a $100 million fund as an example. The fund manager typically contributes about 5% $5 million of their own capital and raises 95% $95 million from other investors. This $100 million can be leveraged to obtain $200 million in debt to purchase $300 million worth of businesses. Therefore, the fund manager can control $300 million worth of assets with just $5 million. The typical fund fee structure is 2 and 20, 2% annual management fees, and 20% performance carry. For a 10-year fund, the 2% management fee totals $20 million over 10 years. If the $300 million business value increases to $900 million after deducting debt and interest, the fund manager will receive approximately $100 million in performance carry. Considering tax advantages, capital gains tax rates, the fund manager actually nets about $80 million. Adding management fees, total income exceeds $100 million. All this from an initial $5 million investment. Fund managers employ multiple forms of leverage, first leveraging $5 million to access $95 million in investor capital, then using the entire $100 million to obtain debt leverage to purchase businesses, and finally using the business's own cash flow to support the debt. This multi-layered leverage amplifies the initial capital by 60 times. In the private investment world, there are 2 major categories: private equity and venture capital. Private equity typically manages larger amounts of capital. The managers of these massive funds are all multi-billionaire level wealthy. Venture capital firms like a 16Z manage about $50 billion. While smaller in scale, they're still enormous. Private equity typically focuses on inorganic growth through M&A consolidation, while venture capital focuses on organic growth, businesses' own viral growth. Successful funds typically possess two key elements: proprietary deal flow and competitive advantages. Proprietary deal flow means access to deals others can't get, thereby obtaining better prices and terms. Competitive advantages manifest as deep expertise in specific industries or business types. Some private equity firms specialize in manufacturing, some focus on consumer goods, some target software, and some specialize in professional services or media companies. This specialization enables them to better identify value and accelerate business growth. Different types of funds have different investment strategies and risk-return characteristics. Private equity typically makes 5 to 10 investments per fund, seeking stable 3 to 5x returns. Venture capital might make 50 to 100 investments per fund, expecting a few massive successes, like 100 to 1,000 times returns, to compensate for numerous failed investments. For founders accepting VC funding, it's essential to understand this investment logic. For the investor, this is a 1% bet. But for the founder, it's a 100% bet. Wealth creation is never accidental. It's the systematic application of correct principles and strategies. In this era, full of opportunities, understanding these paths will help make wiser wealth accumulation decisions. Ultimately, achieving extreme wealth is not just about accumulating money. It's about profound insights into business fundamentals, human nature, and value creation. Each path has its success stories. The key is finding the one that best fits your abilities, resources, and goals, then pursuing it with everything you've got.